I think there's no going back. What I'm seeing, what I'm hearing from these Chinese companies is that this is it. They're just
Wow.
making other plans, basically. The ones that have the ability to, the ones who are overextended, and they're always losers in these situations. Okay, Danny? They're always people who put all the eggs in one basket. They do primarily, U.S. export business. Those guys are going to be liquidated. I think there's no going back.
You're watching Capital Cause. My name is Danny, and today's guest is fan favorite, Eric Yeung. Eric, thank you so much for coming back on the show, my friend.
Hey, thanks, Danny, for having me on again. It's a pleasure.
Yeah, likewise. It is April 30th, 2025. And Eric, I'd like to ask you the same question I ask all my guests kick off the interview to really set the tone for our conversation. And that is, what is most topical for you right now, given everything that's going on in the gold and silver market, the economy, the world in general? What do you think investors should have their fingers on the pulse of right now?
Okay, well, I see a lot of chatter on X right now about the Chinese gold market.
Mm.
People are seeing a lot of people, a lot of retail customers buying physical gold at the China Shenzhen Sheibei, which is the biggest retail gold market in China. And they're wondering, hey, what's going on? Like, I mean, there are a lot of people buying gold in China, but it seems like gold is stuck in this range of 3,300 US dollars approximately. Is hovering in that area. So they're asking me, what the heck is going on? And they're hearing, whispers from, people from China saying that there's a physical gold shortage in China. So that's what I've been looking at. And I talked to a lot of people, industry players in China, and I think I have the answer for those questions.
Fascinating. I know you've sent me a bunch of charts here. Let's kick it off with this Shanghai Gold Exchange gold premiums to discount chart. Go ahead and walk us through what we're looking at here, Eric.
Okay, so that's basically the Shanghai Gold Exchange physical gold price versus the Western spot gold price. So as you can see, China is not always paying a premium for physical gold at the SGE. Sometimes there's a little bit of a discount. But what you do notice, if you compare this, premium discount chart with the gold price chart, you do see that when the gold price is going up, the Chinese tend to be paying a premium.
Mm.
You told me, Danny, before the show, you said in the past, we're talking about 2023, right?
Right. You see it here in the
right?
bottom chart, right? You see these the red chart down below spike up in 2023, and that denotes the discount to premium ratio, meaning that the higher it goes, the more of a premium people pay at the Shanghai Gold Exchange relative to the New York price.
Correct. So so in 2023, China had spiked up to 6% premium, and it settled at the end to around 1.5 to 2% premium. Meaning, people in China were paying 1.5 to 2% more or 6% more for their gold versus London and New York. And if you recall, that's when gold kicked off in terms of price.
Right.
It broke out of $2,000, and now we're at $3,300. So the point being, with analyzing these charts, etc., is that when the Chinese demand is strong, which makes the Chinese gold price higher than the international gold price, gold tend to flow into China from the West, and the Western gold price tend to go up in that scenario. And look at the chart, is proven by historical records. So we don't need to argue about that. So what is happening now?
And that makes sense from like from just the incentive perspective. If you're getting a discount at New York relative to Shanghai, you're going to buy in New York and you're going to sell in Shanghai.
Correct. And what is happening right now? Luke Roman pointed out that right now there's around a 2% premium at Shanghai for gold.
Mm-hmm.
It's actually around 1.5 to 2%. It fluctuates on a daily basis, right?
Okay.
But what he is proposing, or he's theorizing, is that gold is probably flowing from the West to China again right now, and therefore the demand for physical gold in the West is going to pick up because China is now aggressively buying physical gold from London and the COMEX again, and I do agree with that. So back to what we said in the beginning of the show, that's all fine and dandy, but like, what's happening? Why is the gold price still just hovering at $3,300? What's happening in China? Is there in fact a shortage of physical gold in China?
Mm-hmm.
So I can tell you this, Danny. There's no shortage right now. In a traditional sense. Why do I say that? Because as we both know, the physical gold availability is a function of what? It's a function of price. So let's say in China, there's a huge demand for physical gold. What will happen first? The first thing that will happen is that premium that we are looking at will shoot up to, I don't know, 6%, let's say, right?
Okay.
6%, then there's a huge incentive for people to import gold into China from the West. And then people will do that. People will send for delivery at the LBMA or the COMEX, competing with other international buyers and US buyers, right? So the price of the international gold goes up at the LBMA at the COMEX. Yes.
Is that what happened in 2023 as well when you
Absolutely.
saw this?
Absolutely.
Okay.
Yeah. So that, like, what I'm saying is that this will probably happen again, but not right now. Okay?
Mm-hmm.
Not right now. What I'm saying is that if there's actually at any given point a temporary shortage, okay, I use the word temporary, right? Then this will happen. Then the price of physical gold will shoot up in Shanghai first, and then the price of physical gold in the West will follow. It will shoot up as well, just like in 2023.
Yeah. So, I mean, looking at the two charts in tandem, when you see this bottom chart begin to spike up here in 2023, that there's a bit of a lag, but I mean, this essentially happened right before we saw this big surge in the gold price in early 2024. Are the two connected? Is that what you're saying?
I'm saying that, but I'm saying that we're not there yet because the arbitrage is probably not high enough right now. And what will take the arbitrage higher? Well, you have to understand how the SGE, the Shanghai Gold Exchange, and how the gold market works in China. So you have at the Shanghai Gold Exchange, you have all these members. They are basically authorized participants of the Shanghai Gold Exchange. So they are what we call the upstream, players or upstream distributors of the physical gold. And then you have the downstream guys who are the customers of the upstream guys, who are the members at the SGE.
Okay.
So normally, when everything is just normal and dandy, these, downstream customers, which are the jewelry makers, etc., or the bullion sellers, they would buy from the SGE upstream guys. And they pay the SGE gold price. But what happens in a situation where the downstream guys can get their physical gold, or a portion of it, let's say, from a parallel source? Now, you might ask me, what's that parallel source of physical gold?
What's that parallel source, Eric?
It's the recycling guys.
All right. Is that Rongtong Gold?
Okay. Rongtong is one of the biggest in China.
Okay.
Recycling guys. So Rongtong would buy gold jewelry from people in China and Hong Kong, and they would recycle all that gold and make it into gold bars and they'll sell it to the jewelry makers or the
Mhm.
bullion sellers.
I see.
So in a situation where, let's say in the beginning of April, gold spiked to $3,500, you see lineups in Hong Kong of people
Mhm.
selling the gold. Okay, so that the gold supply, at the recycling end spikes. So when that happens, what happens? Well, when that happens, the recycling gold price, I'm talking about the actual bar, the end product after recycling,
Mhm.
may actually match the SGE gold price, or it might actually even be lower for the downstream guys.
Okay.
Does that make sense? We can't see it because the downstream guys don't pay the SGE gold price. They pay the SGE gold price plus the handling fee and the profit
Mhm.
of the upstream guys, right? I'm talking about the
Right.
downstream guys. Make sense?
Pay a little premium, yeah.
Yeah, so they pay a little premium, right? So if they have a choice to buy recycling gold from Wrong Tong cheaper, why not? Okay, so that
Okay.
that whole thing makes sense, right? So that's where we're at right now. They are buying some physical gold from people like Wrong Tong, and they're buying some from the SGE upstream guys. So what happens in this scenario? The upstream guys at the SGE, they get nervous because they're seeing that the parallel source of physical gold is slightly cheaper than their price to the downstream guys. So they are not buying as much physical gold at the SGE.
Mm-hmm.
That part makes sense. So
Yeah.
that means that creates an illusion of shortage because the upstream guys are holding back
Right.
on
So
their purchases.
you're looking for great deals on gold and silver coins and bars from a company that you can trust, then you've got to check out the good folks over at Pimbex. This year, I've really gotten to know these guys, and all I can say is you're not going to deal with a better group of people. They're a family-owned gold and silver online bullion company offering the essentials and more at industry-leading prices while always providing first-class top-tier service. That's PIMBEX.com. And if you're looking to convert some or all of your retirement account into real gold and silver, give Pimbex a call. They'll help explain the process and get you started on the right path. Your support at Pimbex also helps support the channel. So reach out to Pimbex today. You won't be disappointed. And make sure to tell them Danny sent you. So China,
Yes.
China gold purchases appear to be going down, but in reality, it's just occurring in a different avenue. It's occurring in this Rongtong gold and this downstream market.
No,
As
well,
opposed
let
to,
me correct that. They're not.
okay.
It's not even going down. It's not going down. It's like maybe going up slightly at a less steep, angle.
Okay. At
I'm
a
talking about
decelerating
like the
rate.
SG,
Okay.
right? These not like the hockey stick, right? Just like still going up, but not
Right.
as fast, right?
Yep.
And
Decelerating.
exactly, right? So like, and then where are the downstream guys getting all the extra gold from Wrong Tong?
Mm-hmm.
But the good news is that it seems like Wrong Tong, because there are these whispers of shortage. That means Wrong Tong definitely is not satisfying the demand for physical gold. So I
Mm-hmm.
see that this scenario, this situation is only going to be temporary. Okay. So once
And has
everything
this happened?
stabilizes,
This has
yes,
happened before, correct?
yeah, it happened every single time.
Every
Like
single
when
time.
when
And
when top when gold temporarily peaked at the interim top, and then it pulled back. Every single time, the
mm.
SGE upstream guys get nervous. Every single time. At 2,000, it happened. At
And
2,500, it happened. At 2,800, it happened. At 3,000, it happened. And now it's happening again.
I see.
Every single time.
And
Yes.
what's the lag? What's the lag here between the two? I don't know, between the SGE and the downstream markets.
Well, then who knows, right? Who knows how many people are selling their gold bracelet or whatever to
Mm-hmm.
wrong top? I mean, once that dries up at $3,300, then people will have to go back to the SGE or the SGE upstream guys to buy the physical gold bars, and the SGE members have to buy that physical gold from the SGE, pushing the gold price up at the SGE. meaning that the premium is going to go up at the SGE versus the West, prompting importers from the West to pull metal from the LBMA and the COMEX. That means that price at the COMEX and the LBMA will actually, have a rocket behind them to go up like every single time.
Wow.
That's the process.
Wow.
I don't think anybody ever broke it down like this, like I have. but it's not like rocket science, and it's not a conspiracy. It's just business.
Yeah.
That's the way it is, right?
Yeah, I mean, and you've broken it down at the very early stages of the cycle, all the way down to these downstream entities like Rongtong Gold and how they impact the SGE, and then subsequently after that lag disappears and dissipates, the SGE gets revving back up again, and that's when you start seeing gold fleeing New York and coming into China, and then the process repeats over and over again.
I think this time it might actually, just my speculation here. The consolidation phase might actually be shorter. The reason why is because now you have the gold accumulate program at the Chinese commercial banks. Like before, that didn't exist. So now the Chinese commercial banks are buying physical gold at the SGE directly for their end customers for the gold accumulate account. Okay, like that's like basically like a savings account,
right?
But for physical gold for retail customers. So that did not exist in pre-2025. It launched, I believe, in February 2025. So this is new. So that would require a lot of physical gold from the SGE. And then you have the we probably talked about this, the insurance companies, Chinese insurance companies buying physical gold. So that's another 300 metric tons per year of demand. So I think because of all that, I do believe that the consolidation phase will probably be a lot shorter than in the past.
Okay, I see. And you also sent me another chart here. I'm looking at so it says here China's gold bugs turn to ETFs, and it looks like we're having some pretty big inflows into the Chinese gold ETFs. Explain to us what we're looking at here, and explain the significance of this chart.
Okay, so the data is from the World Gold Council, and the chart is from them as well. But I pulled this chart from a Financial Times article that just came out yesterday. And the writer of the article has noted that the Chinese ETFs combined this month had a net positive 70 metric tons of physical gold inflows. That's a lot in a month. Like it almost, she noted that it almost doubled off last month. Okay, but
we can see it in the chart.
Yeah, you can see in the chart exactly. But as you can see in the chart, also it's not always net positive. Sometimes there are outflows. So I think it's fair to say, given the situation right now, we're probably looking at another maybe 200-300 metric tons of net inflows of physical gold into the Chinese ETFs per year. So if we look at, that's the significance of this chart right here. Okay, is that if you take all these numbers and you project it out, you're looking at another 200-300 metric tons per year. So China, at the SGE, it delivered approximately 1,450, around 1,450 metric tons of physical gold per year in the last 2 years. So if you look at all this new demand that is happening, it's very possible that 2025 we see 2,000 metric tons of physical gold demand at the SGE. Possible.
And Eric, could you look at the ETFs as a kind of like a leading indicator for what's to come later on downstream with the physical gold market? Because typically when you start seeing these riskier assets, I'm not saying ETFs are risk, but on a relative basis, it's further out on the risk curve relative to the actual physical metal. The fact that you're seeing inflows into the ETFs, doesn't that signal kind of like this, this quote unquote smart money confidence in the gold space, that they're willing to go further out the risk curve, meaning that there's, probably a lot more meat on the bone than we were let on?
Well, ETFs to me in China tells me where leverage money is going,
Yep.
because at the Bay, right? Like the retail gold market that I mentioned earlier in Shenzhen. Those are physical. That's physical gold bars or physical gold jewelry. The gold accumulate program at the Chinese commercial banks, that's physical. If you withdraw the physical gold bars from
Mhm.
the banks. With the ETFs, you can leverage. So some
Yep.
people say, well, the ETF itself is not leverage. Yes, the ETF itself is not leverage. But if you have a brokerage account in China, you can open a margin account. You see what I'm saying, Danny? You
Mhm.
can you can put in, say, 1,000. Let's make it higher. 10,000 RMB yen. You can borrow 100,000, like 90% leverage, to buy the ETF. So that's what that tells me, is that there's a lot of leverage going on, and
Mhm.
there's a lot of speculators
And
that
and they only
rushed
come
into
around.
the ETFs. Yeah,
Yeah, and these kind of speculators only come around if there's enough confidence in the broader market to take advantage of. So, I mean, once the physical starts to run, you start seeing more of these speculative assets start to run later down the line, right?
yeah, exactly. Look at the chart right here. It tells you a lot.
Mhm.
The every time when that inflow volume spike, that's when the momentum really picked up of physical gold, right? That's when
Mhm.
the gold price is already on its way going up, and then the speculators come in, like any speculator, see that the momentum is there, so they borrow money from the brokers to buy the ETFs
Right.
to make more money, right? I mean, like, what's not to like if you're on the right side of the trade, that is. So the Chinese government actually stopped that. Like when the premium ETFs went up to around 30%, or I'm just using that number arbitrarily because it really depended on the individual ETF, but they stopped it. So what happened when they stopped it? When they stopped ETFs temporarily, all that money probably flowed into the commercial banks through the gold accumulator. Okay, so in my opinion, the Chinese gold market is very healthy. Every time when there's excessive leverage or when that leverage starts happening, the Chinese government step in. That's what we see.
Mm. And
Yes.
so for the average gold bug out there, this should be reassuring, right? I mean, if you're stacking gold for the purpose of protecting your assets, or if from just wanting to see a rise in gold price, this portends to not just a healthy Chinese gold market, but if you've got a healthy Chinese gold market, you've effectively got a healthy global gold market, right?
Absolutely. I mean, I would even buy to say that the Chinese gold market is probably the linchpin of the global gold market,
Hmm.
if you can call it that.
I see. Now, you also sent me another picture here. This is from Trading Economics, and it looks like so. It says Chinese exports to United States. So go ahead and walk us through this
Yeah,
chart. I see electronics at the top, electronic equipment at the top with a $124 billion valuation, followed by machinery, nuclear reactors at 89 billion, et cetera. What are we looking at here?
we're looking at like people telling me on a daily basis, probably coming to you as well, saying that China only makes plastic crap.
Hmm.
And it doesn't matter if the tariffs kick in, the U.S. companies will just stop doing business with China cold turkey. What I'm trying to show people here is that China doesn't own crap to the U.S. It's that simple, right? So if you look at these data points, I mean, it's very very it's very apparent. The top item, like you said, electronic equipment, $124.52 billion. Machinery, nuclear reactors, boilers, 88.98 billion. Furniture,
Hmm.
lighting signs, the building there, those are modular buildings. Okay. So they actually make like, when you see huge constructions in the US or elsewhere in the world, and you wonder how they get that building up so fast, because they all built modularly now, and part of that building, of the parts of that building, is manufactured in China. They ship it in little blocks like Lego, and they assemble the building really. So that is $30.66 billion. And then you have the toys, games, and the sports equipment, and then you have the plastics, 23.25 billion. So my point being, yes, plastics is a part of it, but certainly not the biggest component
Right.
of
It's a
what
small
China is
sliver of
exporting to the
the
US.
total. Yeah. Go ahead.
Exactly. So that's the whole point of this chart, and because that's what I do for a living. I was a contract manufacturer, so I know quite a bit about manufacturing in China, the effects of the tariffs, etc.
I mean, what do you anticipate coming out of these tariffs? You have President Trump saying that China's going to come to the table any day now. China has declined any sort of talks with the United States, but they seem to be making deals with other countries, even the likes of Japan. While we're just sitting around waiting for a deal here in the United States, we're waiting for a call. While we're sitting and waiting for a call from China. China's going out making deals with other countries and creating their own free trade world order. What do you make of what's been ongoing? Can the United States withstand? I mean, is China really incentivized to come to the table at this point?
Well, I mean, Chinese government always want to make a deal if it's a reasonable deal, right? Not a deal like China. I think the Chinese government made a video. Well, I don't think I know because I saw it. Made a video of China's position, in this trade war, in this tariff fiasco, and the Chinese government basically said it's not going to negotiate with the U.S. at gunpoint. It has to be a negotiation process where both parties have goodwill, and things cannot be agreed upon under threat. So that video came out yesterday, right? But in terms of like what's happening right now, if you are a Chinese factory or a Chinese company, and you were vendor financing your American customer, net 180. That's 180 days upon the product arriving at the US location of your customer. And all of a sudden, you get a call from your customer and saying they want to cancel all the orders because of the tariffs. You're that Chinese factory, so you're losing millions of dollars, right?
Mm-hmm.
Are you going to continue to take on these US customers? I mean, even if, let's say, things improve on a temporary basis. I mean, things change so much on a daily basis. Like, I mean, Donald Trump can say something in the morning, and then in the afternoon is something else.
Mm-hmm.
Right? Me and you both seen this. It's pretty crazy. So if you're
Eric,
if you're running a multi-million,
it's all part of the plan, Eric.
Okay, but if you're I understand that. But if you're a Chinese factory, you're only doing 14.8% of your business with the US, because that's the official number, by the way. China only only 14.8% of China exports go to the US. Okay, so you're a Chinese factory. 14.8% of your customer base is defaulting. Are you going to keep losing money?
Nope.
On an ongoing basis. So I wrote something on X. I said, people just don't understand. If the Chinese companies continue to do business with these American companies, these Chinese companies as a whole is going to lose trillions of dollars over time. It's crazy, right? Like they won't continue doing, money losing business. It's just not going to happen.
Yeah, no one would.
It's that simple, right? So, I think there's no going back. What I'm seeing, what I'm hearing from these Chinese companies is that this is it. They're just
Wow.
making other plans, basically, the ones that have the ability to, the ones who are overextended, and they're always losers in these situations. Okay, Danny? They're always people who put all the eggs in one basket. They do primarily, U.S. export business. Those guys are going to be liquidated. It's that simple. But then once they're liquidated, somebody else is going to step in, right? That's it. So they're going to be winners and losers in this whole story. That's what I see.
Do you see BRICS remaining intact here, or does BRICS become stronger as a result? How does this impact BRICS as a whole?
I think BRICS is just an alliance of people who want to do business without being threatened on a daily basis. That's all it is. It's not a military alliance, right? It's an economic alliance for free trade, for lack of a better word, right? Or they're trying to do free trade with their own national currencies. Okay, so it's the embodiment of polarization of the world, right? So I do see that strengthening because that's the only other option. With Uncle Sam saying, you're either with me or you're against me, or I'm going to punish you every 2 seconds. I think the BRICS is the only other avenue out of this doom loop, for lack of a better word.
From a strategic standpoint, if you're any one of these other countries, and you're thinking about making a deal with the U.S., and the U.S. still hasn't made a deal with China, aren't you kind of inclined to just wait and see if a deal is made with China before caving in, i.e., wait to see if China does or does not make a deal, and then make your move in that regard? Because whether or not China makes a deal, that's a huge huge event for the United States. It's not something. It changes the entire game theory for everyone else. If the United States is unable to make a deal with China, then it puts all these other countries in a better bargaining position, and vice versa.
I think it's more than just trade, Danny. I mean, look at the U.S. national debt. It's almost $37 billion. And the U.S. Treasury came out yesterday saying that they need to borrow, probably up to over $500 billion in the next quarter. I mean, this thing is accelerating. So you are a foreign country doing business with the U.S. What do you get out of it? The U.S. is going to pay you a whole bunch of IOUs. And then what do you normally do in the past? You buy U.S. Treasury T-bills or U.S. Treasury bonds. But looking at the data, I mean, like, not a lot of people like to buy the long duration U.S. Treasury bonds because it's pretty insane, right? Like, I mean, you have this country that is in debt for $37 trillion and counting. It's never going to pay it back, really, right? So you're a foreign country. What you do is you try to buy as much short duration as possible if you're forced to buy it, which is exactly what's happening. And going back to what you said, I think these countries are looking at an alternative to this whole fiasco, right? Not only trade, but the monetary system as well. And what they have chosen in the last couple of years is physical gold as an alternative, neutral, global, international asset. So that's what we see.
Yeah, and you saw that exemplified in the Liberation Day market crash, if you want to call it that, where the DXY went down alongside the stock market, which is unconventional. That usually one goes up and the other doesn't. But it's just another sign that the world is moving away from U.S. based assets, and that includes the dollar as well. Anything else you want to talk about here? I think we've covered pretty much everything I had in store for us. But if there's anything else we didn't get into, feel free to talk about before you wrap up here.
Yeah, just want to add one more thing to what you just said. People talk about liquidity. Every single time when these markets fall, people talk about US dollar liquidity that is driving it, right? I think right now and ongoing, the most important thing is probably going to be physical gold liquidity instead of US dollar liquidity. I explained it in one of my posts. I said it's simple enough, right? At the end of the day, why would the gold price go up when there's a US dollar liquidity crisis, or when US dollar liquidity actually is contracting, let's say, right? Why would physical gold go up? I'm saying a hypothetical situation. We saw that, by the way, like you said, recently, right? When everything fell, including DXY, including the US Treasury market, gold went up. What would drive that? The only way that would happen is if the entire world seeks physical gold liquidity and there's not enough physical gold out there for people to buy at the current price, right? So what that means is relative, right? What I'm trying to say, that is relative, right? If the physical gold liquidity is even in more of a lack than the US dollar, then we'll see this situation again where everything goes down, including US Treasury bonds, but physical gold price goes up.
And the physical gold market is a relatively small market compared to, relative to everything else, right? I can't remember what the exact market cap is. It's like 20 trillion or something close to that. Where else in where everything else is in hundreds of trillion. The bond market is far more vast than the physical gold market. So once capital begins to leave things like the stock market, especially the bond market, and comes into this relatively small market like the gold market, and eventually over time, dare I say, the silver market, which is even more small, then who knows where the price goes at that point?
Absolutely. I think we are just at the I say we're at the end of the beginning. Okay, we're at the end of the beginning. So we're getting into the second act of this exciting play. So let's just watch and see how it plays out. That's
all right. Well, Eric, thank you so much for coming on, my friend. Where can people find you if they want to learn and see more?
I'm on X at KingKong9888.
All right. We'll have to link that down below. Be sure to check it out, guys. Guys, thank you so much for watching. Also, don't miss out on our special offer on the Trends Journal. That's Gerald Salente's Trends Journal. We have a link to that down below. Get your 10% off on the Trends Journal. I can't recommend it enough. Gerald Salente packs this thing with tons of information and research, so you don't have to go out there and scavenge the internet and waste too much brain power and headspace trying to piece all this stuff together. It's all perfectly set up for you at the Trends Journal. Link to that down below. Be sure to check it out. Subscribe to the channel so you don't miss another episode. Like and comment down below. Comment go, Eric, go if you agreed with Eric's analysis. If you disagreed with anything, that's okay too. Let me know what you disagreed on, however. I do read the comments. Whether you like, whether you subscribe, whether you comment, everything goes a long way in helping us boost this channel and this video in the algorithm. So it'd be very much appreciated to do so. And then also check us out on capitalcosm.substack.com, where you can get early access to all of my videos, ad-free versions, as well as uncensored versions for the ones that warrant it. And you support me in a monetary fashion there as well. So, all right, guys, thank you for watching, and I will catch you in the next episode.